The stock for Plug Power Inc., ticker PLUG, is currently trading at $2.21, reflecting a minor intraday movement of minus $0.02, or a minus 0.90% decline from the previous close, based on the last recorded live trading data from December 4, 2025 at 12:04 p.m. EST. The market consensus, the general expectation about Plug Power, is often framed by its highly visible, volatile swings, a story of monumental potential in green hydrogen, constantly battling the reality of consistent cash burn and the dilution that follows. This latest price action, a small dip on substantial volume, appears unremarkable on the surface, just another day in the low single-digit price range. However, the real insight, the element that should capture your attention, lies not in the price change itself, but in the context of its latest corporate action, the rescheduling of its special shareholder meeting to January 29, 2026. This seemingly administrative delay, primarily cited to give shareholders more time to recall loaned shares and vote, is a direct acknowledgement of the enormous, levered battle currently being waged between long-term investors and the massive short-seller community. The company is, for all intents and purposes, publicly recognizing the short pressure as a material factor influencing shareholder turnout and corporate governance, which is a surprisingly transparent move for a company frequently criticized for its opaque financial footing. This is where expectation meets a deeper, more complicated reality. The company is fighting fire with an administrative firewall, but the question remains whether it can solve the fundamental economic problems that fuel the short thesis. The common understanding of Plug Power sees a pioneer in the hydrogen fuel cell space, positioned to capitalize on the global push for decarbonization, particularly in material handling like forklifts, and eventually e-mobility and stationary power. Investors are drawn to the vision, a fully integrated, end-to-end green hydrogen ecosystem, from electrolyzers that produce the fuel, to liquefaction and delivery infrastructure right down to the fuel cells themselves. They are betting on the company executing its ambitious plan to build out a green hydrogen highway across North America and Europe, targeting that crucial transition from an industrial startup to a scalable, profitable energy provider. But the market reality, which is the relentless downward pressure on the stock, highlights the substantial and persistent chasm between this compelling future narrative and the current operational finances. The recent swing that brought the stock from its October highs near $4.58 back down to this $2 range is a textbook example of this tension. The volume has been heavy, with recent trading days seeing volumes far exceeding the average, indicating a genuine, high-conviction contest between buyers stepping in at these depressed levels and sellers, both long holders cutting losses and short sellers maintaining their leverage. Institutional activity tells a mixed story. While filings indicate major index funds like Vanguard and BlackRock are large holders, which is typical for any public company of this size, the net sentiment from new institutional filings is often skewed by the constant need for capital, which overshadows any new commercial contract win. For instance, news of a new 5-megawatt PEM electrolyzer LOI in France, or the commencement of a liquid hydrogen contract with NASA, are positive catalysts, demonstrating execution and opening new high-value markets. But these flashes of progress are quickly extinguished by the specter of continued quarterly losses and the necessity of further capital raises, the latest being a convertible note offering that sparked the most recent major sell-off due to the dilutive impact. This brings us directly to the core of the market skepticism and the most compelling part of the current stock story: the intense short-selling activity. The expectation for a hydrogen giant is a smooth ascent. The reality is an air pocket created by short interest that is currently sitting at over 305 million shares, representing a massive 23.31% of the float. This is an extremely high level of short interest, creating a days-to-cover ratio of around 3.65, which means it would take nearly 4 days of average trading volume for the short sellers to buy back all the shares they need to cover their positions. This figure alone explains the extreme volatility and the underlying tension in the stock. Short sellers, including prominent but undisclosed hedge funds, are motivated by a clear and simple thesis. The company's business model, as it currently stands, is structurally unprofitable. They point to persistently negative gross margins, massive cash burn, and the high capital expenditure required for building out the hydrogen infrastructure, arguing that the company will not reach scale and profitability before it needs yet another dilutive capital raise, thus perpetually pushing the expected payoff date further into the future and eroding shareholder value. The argument that the company's valuation, despite the deep price drop, is still high on a price-to-sales basis compared to industrial peers justifies their bearish position. The observable short-selling pressure extends beyond just the raw number of shares shorted. The off-exchange short volume ratio, which tracks shorting activity on dark pools and other non-exchange menus, has consistently been around the 50% mark in recent trading sessions. This indicates that half of the reported off-exchange volume is short selling, suggesting a sustained and coordinated effort to drive the price down, or at least hedge against a rally. The borrow fee rates, while fluctuating, have been relatively low, suggesting a ready supply of shares to borrow for shorting, which prevents an immediate powerful short squeeze from forming. But the sheer volume of fails to deliver, which reached over 2 million shares on November 14th, shows temporary delivery bottlenecks and potentially aggressive naked shorting that adds fuel to retail forums' debates about market manipulation and transparency. Retail investors, as seen on sites like Reddit and X, Twitter, are keenly aware of these figures. The current debate online is often a mix of deeply held conviction in the long-term hydrogen vision and frustration over the perceived artificial suppression of the stock price by large funds. This is a very common scenario for heavily shorted stocks: long-term conviction versus short-term financial reality. For a retail investor watching this intense battle, the actionable insight is not to blindly follow the short squeeze narrative, but to monitor two specific signals: the days-to-cover ratio and the option open interest. While a high days-to-cover is necessary for a squeeze, it must be paired with a sudden spike in the short borrow rate or a significant positive catalyst. The current low borrow rate means short sellers are not feeling acute pain yet. On the options front, the overall put-call open interest ratio sits at a rather low 0.27, which counterintuitively for a heavily shorted stock suggests bullish sentiment among options traders who are holding significantly more open call options than put options. This is a critical point. Sophisticated traders are betting on upward price movement over the next few months, an expectation that is entirely contrary to the short thesis. Investors should monitor the open interest for calls at the $3 and $4 strike prices, as a rush of buying volume there could signal a psychological turning point. Do you think the government will pass legislation in favor of the hydrogen industry anytime soon to finally change the economics for companies like Plug Power? Comment below with your honest take on the likelihood of a massive hydrogen tax credit. The company's core offering, GenDrive, GenSewer, and ProGen products, center on hydrogen-fueled proton exchange membrane (PEM) fuel cells. This is not just a technology play, it's an infrastructure play. They sell the fuel cells and the fuel to power them, locking customers into a service and maintenance loop. The problem, as the short sellers correctly identify, is that the margins on both the equipment sales and the fuel delivery have been deeply negative, a challenge exacerbated by rising hydrogen costs that the company struggled to manage, leading to massive gross losses. The company is actively working to correct this, largely through its push into building its own green hydrogen production plants, the goal being to own the entire supply chain, reduce dependency on external high-cost suppliers, and ultimately flip those gross margins positive. This internal production is the entire basis for the long-term bull case. Recent insider activity showing more open market buys than sells in the last 12 months provides a small, positive data point, suggesting that those closest to the business see value at these depressed price levels, though these buys are dwarfed by the massive institutional holdings. Looking ahead, the future outlook for Plug Power hinges entirely on operational execution and macroeconomic tailwinds. The expectation is that government support, primarily from the U.S. Inflation Reduction Act, IRA, will eventually subsidize the green hydrogen